Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. On my continuing focus on the housing crisis, I've run across an interesting gentleman and a really interesting article about rental housing, and I wanted to reach out to him and understand it a little bit more. Christian Szpilfogel is our guest tonight. He is an experienced real estate investor and entrepreneur, and he currently serves as the Chief Investment Officer of Alferis. Is that correct? Alferis Group. He offers coaching and consultant services to real estate investors who are looking to gain confidence and new knowledge in their investments, as well as in their overall returns. And he's written an article, a really interesting article recently, on rental housing and what went wrong. And the opening of it sort of grabbed me because you said that we actually had, a good rental system, affordable rental housing system 50 years ago, and then something went terribly wrong. What went terribly wrong?
There were a few things that went terribly wrong, but it really all went south in about 1972. So just to give you a bit of background, when I take a look at these things, I look at it in a very, dispassionate fashion. I try and understand the facts. I don't try and color it. And that's just because of my scientific background. So I wanted to understand exactly why things ended up the way they did. So when I went back, I looked all at the data, stats, CAN, CMHC, et cetera, and various other pieces of information. And what I found was that prior to 1972, we actually had a very healthy rental environment. We were creating lots of rental stock. Vacancy rate was at around 6%. And then it all went off a cliff in 1972. And the key contributors to that were, one, in 1967, we brought in the Condominium Act, which really kind of defined and enabled the ability to create condos. And that in itself wasn't the problem per se. But in 1972, the federal government went through a tax reform act, which created certain incentives that favored the creation of condos over purpose-built rental apartments. And so we went from a vacancy rate of about 6% just prior to 1972 down to a vacancy rate of about 2% by 1975. And we've been bouncing around there 2 to 3% ever since for the last 50 years. And the volume of what we actually built for rental housing went from, in the 60s, it was around 30,000 new units in Ontario alone per year, up to a peak of 40,000 prior to 1972. And then it dropped down to about 5,000 units per year by 1975.
That's interesting. I always thought it was rent controls that had the big impact. You're saying it's the Condominium Act and the federal tax reforms. How did this Condominium Act and tax reforms, you say it was a disincentive for developers to build purpose-built rentals?
Yeah, I mean, rent controls does have a part to play, and there was a lot going on between 72 and 75 because the Bill Davis government at the time was at risk of losing the 75 election, and the NDP later became the official opposition. So there was a lot of pressure to introduce rent controls, and they were introduced by 1975. So they are a contributing factor. They're not the only factor. So now let's go back to your question about what happened in that scenario. When developers have a business case, right, they're looking at certain financial metrics in order for them to decide whether they do project A or project B. Okay, most finance people refer to that as an internal rate of return. And so without getting technical, what happens is if you are looking after those changes in the Tax Act at the time, what ended up happening is it was more favorable for developers to build condominiums rather than rental housing. It was really that simple. And the only thing—
What happened in the Tax Act that did that?
There were a couple of things. One, capital gains tax was introduced. Okay, and the other thing was there was also capital depreciation or rapid capital depreciation that existed prior to 1972. And then basically a depreciation schedule happened, which meant that you couldn't write it all off very quickly. So when you do that, like a condo, if you build it, you sell it. Okay, it's done. And you get all your money very, very quickly. If you have rental housing, then typically what happens is you build it and you have to hold it for a long period of time. So if you can't write off the capital cost on the construction side quickly, then what happens is you have to write it out over time. So your rate of return becomes worse, and therefore most developers would just favor condo development.
That's interesting. So what you're suggesting is we should change the tax act and accelerate the depreciation on rental housing building.
That would be a really good way of doing it. I mean, fundamentally, we need to create tax incentives to encourage people to do what we need them to do, right? So if we want rental housing, what we need to do is focus on specific incentives that are going to make the business case more favorable for rental housing over other types of things like condos. Now, to be fair, condos did end up paying, saving our bacon in a different way, because CMHC, of course, was allowing people to buy secondary homes more efficiently. So smaller landlords later became part of the solution in our rental housing supply issue, because they started buying the condos and then they started renting those out. And it's interesting, and we might want to dig into this later, but well over half of all rental housing is now provided by small landlords, small individual landlords.
Is that actually good?
Well, it depends who you talk to, I suppose. So on one side, you can say, well, smaller landlords don't have as sophisticated a process and sometimes can create issues with respect to tenant arrangements. But on the other side, they provide a ton of flexibility in the system. So one of the simplest solutions is if we de-risk small landlords, they have the ability to respond very quickly to market needs, faster than larger developers. So, for example, a large developer, and I know you've covered this in your show before with respect to municipal processes associated with building new projects. There's a long timeline. Like with some of my projects, the smaller projects can take 2 years to get through an approval process. A bigger project might take 4 or 5 years to get through the approval process. But a smaller landlord or a smaller owner and smaller developer can literally just turn around a new unit inside of a year. So if we create certain incentives for them or remove some of the risks that they bear, then they're more inclined to create new rental housing.
So it's interesting. I would have thought that that the issue is more, number one, that the amount of leverage one could get against a condominium, because you've got known sale within a certain time period after you've got, with the pre-construction sales of the condo, deposits put down. You're going to get a certain amount of money, date certain, when you've completed the construction and you've got the occupancy permit, versus rental, where some people might rent before it's built, but you're going to have some ramp up absorption time period until it's actually fully occupied, and then maybe you can get a whole bunch of debt on it. And so therefore, what banks tend to do is lend less money against a rental building than they would against a condominium building, and so therefore, because of that, the return to the developer goes down. And then I would have thought as well that, the typical rental price, if you sort of valued it, would be less on a per square foot basis than the typical condominium sales price. And so for two different reasons, if you're getting more money and you can leverage your investment more, then it just makes logical sense to build a condo, doesn't it?
Your second point is spot on, and that's absolutely right. So you're right in terms of the revenue per square foot or the value per square foot associated with a rental apartment is lower than it would be for a condominium. And it's probably about 25 to 30% discount, and that effectively affects the outcome and value of the building. But the other thing that matters is time, right? So with a condo, and going back to your first point, with a condo, you get investment from the pre-sales that were happening, and then there's a close at the time that the condominium is actually stabilized, which is normally very quickly after completion. And therefore, because the time is short, it actually inflates the value of the internal rate of return. So your business case is actually financially stronger because of that. Now, in terms of the leverage actually doesn't quite work that way. So with a condominium development, the banks will typically loan you up to about 65% of the value of the building, then you have to go for another round of more expensive financing, sometimes called mezzanine financing. And then the developer itself actually has to put in a chunk, usually 10 to 15% on that other end of it. So it's a bit harder to fund it on that side, but it's ultimately doable, and there's a process for it. One of the good things that CMHC does is they do have programs for construction of rental housing, and it is one of the incentives to build it. And in that case, there's a new program that was just introduced at the federal level called MLI Select. And without getting into the details about it, it does allow longer amortizations. It does allow a higher leverage associated with the property, so long as it meets specific criteria related to energy efficiency, accessibility, and affordable rents.
So, and you can get cheaper financing with CMHC as well, can you not?
100%. Yeah, it's less expensive on the takeout specifically. So we have to largely fund everything at the front, right? And that's expensive money. Right now it's running at about 10%, and historically it runs at about 10% interest that we have to pay on that. And there's tons and tons of fees associated with it. But on the equity takeout later on, once the building, and as you said, rental buildings take a little bit to stabilize when we complete them. But once they're done, we can then do an equity takeout. And with CMHC, that interest rate is lower. But there is a stipulation. The money that comes out from CMHC can't go back to pay back your investors. The money has to move forward to other development. So for us as a company, it makes sense, right? Because we're continuously building new development. But for others, it may not make sense. And on the condo side, there is no such stipulation, of course.
Sorry, I didn't understand that. So you're saying that if I leverage up with the CMHC financing, I cannot use that money to distribute to the investors. I've got to use that money for another development.
Another development, yeah, effectively another development. You can use it for rehabilitation of existing stock that you have, right? But the key issue is that the money can never go back to the original investors. So how
do the original investors ever get the money?
If there's CMHC and financing involved, they're basically stuck in there indefinitely. So you'd have to refinance out of CMHC to be able to get that money back to them.
That sounds a little bit challenging. We're going to take a break for some messages and come back in just 2 minutes and talk a little bit more about this rental housing market, the housing affordability crisis that we are faced with in Toronto, Greater Toronto Area, Ontario, Canada today, and what Christian Szpilfogel's recommendations are on how we're going to solve it. Stay with us, everyone. Back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is Christian Szpilfogel. He is the founder and chief investment officer of a private investment firm in Ottawa with a focus on real estate and startup technology firms. Sounds interesting that you got both real estate and technology. That's really quite interesting. And he's written a very good, detailed article recently about rental housing. And why we don't have more of it. And so I thought it would be interesting to check in with him on why. He talks about the different asset classes that we have: apartment building developments. He's got a degree in physics. He's worked in the Ontario tech sector since 2017, and he's an advocate for balanced rental housing policy at various levels of government. And he's spoken as a witness at the Parliamentary Committee on Rental Housing in June of this past year. I wonder if we could talk about rent control, because you talked about how Davis instituted rent control just before the 1975 election, and that was something that was key for ensuring that he didn't lose all the progressive or the centrist votes. Rent control has come under a lot of negative press and perception recently, and been described as the villain of why developers don't want to develop rental apartment, because why would you want to develop a rental apartment if you're stuck at 1-2% increases in rents when inflation is whatever it is? So I'm surprised that you're not more critical of rent control. Tell me a little bit more about rent control and the impact it has on rental housing.
Yeah, so rent controls is a funny creature because it's evolved over time. So in 1975, rent controls was a reaction to the shortage of rental housing. So when the vacancy rates went low, rent started to go up in price, and therefore there was a backlash, and the tactical answer was rent controls. Now, I'm critical in the context of rent controls because I really actually feel that they're not good for tenants. I think there's a negative impact to tenants fundamentally on this. I feel that it's less of an issue for landlords in general, with the exception of the small landlords. Small landlords have a significantly negative impact from rent controls. And there was a change done about almost 10 years ago now, where they introduced not just, so rent controls right now are limited to CPI in Ontario. They were limited to CPI. And then what happened about 10 years ago is there was legislation put in place that said, regardless of what CPI is, we're going to limit it to 2.5%. So over most of the last 10 years, that hasn't really been much of an issue. But clearly through this high inflationary period where inflation was running at 5 to 7%, what ended up happening is our hard costs were actually going up by at least 5 to 7%. In fact, they've been going higher than that because things like property taxes, insurance, utilities have been going up ridiculously high. But at the same time, we were limited to the amount of rent increase to being 2.5%. As opposed to what inflation was running at. So that's become an issue. And then because of the rent controls and rent disparity, what happens is people are less likely to move as well. So churn rate has been down to about 4%, which means that property owners are having trouble on a larger scale to be able to recover their costs effectively. So at least in Ontario, we have this thing called vacancy decontrol, which means that when a tenant moves out, we can reset to market rent. And that helps in order to be able to catch up over time. But the problem is that with a lower churn rate, i.e. people moving in and out, the ability to catch up is slowed down significantly, putting a lot of rental housing owners under more financial duress.
I interviewed a gentleman that's made a business out of buying apartment buildings and paying people that are renting some of those apartments to leave so that he can renovate them and jack up the pricing. He actually pays them sort of, it's almost the opposite of key money. It's an incentive to leave money so that he can, renovate it, fix it up, but then jack up the pricing to a more reasonable market rent.
Yeah, it's a concept called cash for keys. I'm not a big fan of it, to be perfectly honest. And certainly in our own developments, what we do is we wait for tenants to naturally turn over. But what they try to do is an incentive for people to leave. And by doing that, and some people will accept it, and sometimes it's a favorable arrangement. So if the person receives a large sum of money, that's a reasonable compensation for that kind of exchange. But what I don't like personally is when it's used as a bully tactic, right? Where people are trying to be pushed out of their homes. And I don't subscribe to that. So I'm very much about a balanced market. I want to see fair treatment of tenants as well as property owners.
I interviewed and met another developer that was interesting. He says, when you develop a condominium, yeah, you put in some amenity space, but then you're out of it and you leave the condominium association to run the place and operate it. And the challenge with rental housing is you got to be a little bit like Club Med, because you got to have that amenity space. And he said, Brian, if people start dating, making friends with, and doing business with other people in the apartment, then they'll stay. And that's good, because then your churn goes down dramatically. You don't want no churn, because that churn gives you the opportunity to jack up rental prices, but you also don't want vacancy. And you don't want a lot of churn, because when you got churn, you gotta fix it up anyway, just to get the new people in there. And so he said, you've got to effectively you're almost running a social club. You got to have events. You got to have people that meet each other. You got to have people that like each other. You don't want them to get married because then you lose one unit because they end up combining into one from two places into one place. But you want them to date. You want them to get together. You want them to get business together. Is that true?
Yeah. Well, I think so. Well, it's an interesting concept, and it is to some degree, right? You do want to have people that are compatible within the building, right? Because they all have to live together. But when we're talking about the churn rate, you need to be careful. As you said, you don't want the churn rate to be too low, otherwise it inhibits your ability to catch up. And if your churn rate is too high, then it is too cost. So there is a sweet spot where you want to be able to get a churn rate in the order of about 25%, 20 to 25%. That's where we find it to be optimal in Ontario. So if you can hit that, that's fine. So you're right. You have to sort of tune the amenities and the services, not just to make people happy, but also to just kind of figure out where your optimal churn rate is. Because to your point, if you make people way too happy and they never want to move, to some degree, that's good, and that's stability, and it's less work from an operational perspective for us. But then because of rent controls, it becomes a real problem. So you could argue that that kind of thing, that rent controls kind of forces you to want people to not necessarily be in the same place for too long.
Your article was interesting because you walked through a couple of trends that I think are all pretty obvious to people, but when you see them mathematically, it's kind of interesting. You talk about immigration, and we've gone from reasonable immigration to immigration that's 500,000 people a year, and last year was actually 1 million people as we caught up from some of the lack of immigration during the pandemic. You talk about rural to urban, and your statistics of going like 30% urban in the 1900s to 70% most recently, and then up to 80% in the last couple of years, such that rural to urban migration just continues and continues. And then you had an interesting analysis where you said that baby boomers are selling their homes, cashing out of their home equity, and wanting to rent, while millennials can't afford to buy the homes, and so they're renting. And so you got to squeeze on both ends. And so you go through a lot of interesting statistics, but then the most shocking one is that even with all those statistics of increased demand, your supply goes down dramatically. It's like 1/5 or even maybe 1/10 of the supply that it was in 1969 of rental housing.
Yeah, it is. It's about 12 to 15% of what it was at that period of time relative to the overall population. So that is because, again, we're not incentivizing the creation of purpose-built rental housing. But as I said earlier, the slack was picked up in what's called the secondary market. So CMHC divides things as a primary market, which is basically buildings with 3 units or more. And there's a secondary market, which is single family homes and duplexes. And so CMHC doesn't measure the secondary market. They tried, but it was too complicated. But what we do know, and there's enough data that CMHC was able to compile, is to see that at least what they categorize as a small landlord, if you will, an individual investor is what they call it, there was over 49% of the rental housing was owned by the small individual investors. And that is only in the primary market. So if you then take the secondary market, which is going to be dominated by the small mom and pop owners, then you're looking at about 70% of all rental housing in this country is actually operated by small mom and pop landlords. And you were asking earlier whether that's a good thing or not. Again, I said it depends on the perspective, and I talked about it from the perspective of the tenants. But we also have to recognize that most people don't have a pension plan in this country as well. So what a lot of these landlords are doing, is really buying an investment property as a way to store money for their wealth towards their retirement, so that they can eventually retire in a good way. And real estate is a way that can be done.
But to get access to it, you got to sell it or do a reverse mortgage or something.
Yeah, you would have to sell it. You may sell it to another investor, another small mom and pop investor, and release the cash, or you've paid off the principal sufficiently that the cash flow coming out of that property is actually paying for your lifestyle, and that's your retirement fund. So you don't necessarily have to sell it, right? But you can do it either way.
The other thing that I find fascinating about your graph and your analysis is that the total number of housing starts per year in Ontario are less in the last 2 decades than they were in the 1970s. And yet our population has doubled in that time period. And so therefore, on a per capita basis, our housing starts have gone down by 50%, if not, frankly, more than that. How can we survive? And this isn't a 1-year thing. This is like a 20-year impact. How can we survive if we have housing starts that are less than half of what they were back in the 1970s?
Well, I think to some degree that's a rhetorical question, because you're absolutely right. Amongst the OECD countries, we are doing significantly less new starts relative to population growth, and it's a real problem, and it's clearly catching up to us. And I know that you've talked before, because I do listen to your show, that what's been happening is that there's a lot of things that are slowing down the creation of housing in general, not just rental housing. Part of it is municipal development timelines. Part of it is fees and taxes at various levels of government, to be fair. Like you've probably heard this stat before, but about 30, at least on my experience in the rental housing side of it, about 30 to 35% of the cost of new development for rental housing is taxes and fees associated with various levels of government.
Hold it. 30 to 35% of the cost of new rental housing is taxes and fees. Is that what you just said?
Yes. That's right.
Huge.
It is huge. And so I kind of look at it and say, okay, well, wait a second. The government gets about 30 to 35% of the cut of the cost associated with zero risk. And the developers, and I know that most people are not going to be sympathetic to developers, but developers basically make about 10% on average, maybe 12%, shouldering almost all of the risk associated with it. So it's not quite right. And now if I flip it around a different way, and one of the things that I brought up in the parliament.
Well, and what that says is that the housing is 30 to 40% more expensive than it needs to be.
That's exactly.
Or maybe you could argue that, GST is, HST is 13%. So maybe it should be 13%, but that still is 27% more expensive.
It's a significant cost. And the way I presented it to the parliamentary committee was a slightly different way. So let's use Ottawa for, because that's where I'm basically investing and building. And in order for us to build and afford to build a new rental apartment here would mean that we have to charge a minimum of $1,700 a month for a 1-bedroom apartment just to break even based on current development costs. Now, what that means is, that 30 to 35% tax, if let's just say it was all gone, the starting rent, the base rent that we could start off with in a perfect world would be at about $1,100 a month. That's the way to think about it, right? So $1,700 starting versus $1,100. So that gap is basically taxes and fees.
Or another way, at the same price, if it didn't go to government, there would be a lot more incentive for developers to develop, and we could have 30% more supply.
Well, certainly that would be the case, right? Now, to be fair, municipalities have infrastructure to build, right? But there's a variety of ways of getting that accomplished. But I just want to give you some examples.
But why should it be funded just by the new development when society needs these homes? What we're doing is we're making it uneconomic. And let me take you back to another statistic. Actually, you know what? I'm going to take you after the break to this other statistic, because you've got it in your article, and it's absolutely fascinating because it compares single family homes versus co-ops and rental to what else did you compare it to? And you show a fascinating comparison. It's condos and houses versus rentals, and it's absolutely fascinating, because I think there's something to be drawn from here. We're going to take a break for some messages and come back in just 2 minutes with Christian Szpilfogel. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're chatting about the housing crisis again. I know you're going to say this is something I talk about a lot, but I think it's the number one issue, other than, climate change, which I think is a very long-term issue. I think this is the issue for our generation right now, because I fear that we're making it completely uneconomic for our kids to enjoy the lifestyle that we enjoyed. And I think it is local politicians that have been primarily at fault because of the regulations that they put in place, the red tape that they put in place, the NIMBYism that they allow to exist that has restricted supply. And yet I got to wonder about that whole analysis and conclusion that I've come to when, Christian, I look at this one graph that you've got that is really quite fascinating, because what it is, it's the number of dwellings in rentals and co-ops versus condos versus houses over the course of the last, 50 years. And what you show is that houses are between 30 and 40,000 starts a year, almost consistent through the whole time period. Mm-hmm. And so when you think about all this press about, we've dramatically reduced our housing starts, what this graph says is we haven't on single family homes. We're building, now the population has doubled. So maybe the answer is that we should have doubled the starts and we didn't, but the construction of single family homes looks to the eye, I'd be interested in the raw data, but it looks to the eye that it's between 30 and 40,000. This is Ontario numbers, between 30 and 40,000 per year. The condos have grown dramatically, as you'd expect, because of all of the development of towers in Toronto and, every other suburban area around Toronto. But what has been decimated in housing starts is exactly what is the topic of this conversation in your article. It is rental housing. Rental housing has gone from 40,000 a year during most of the 70s to 20,000 a year for most of the 80s and the 90s to less than 5,000. And it looks like about 2,000 or 3,000 a year for most of for this century, the last 23 years. Yep. It looks like the problem that we've got based on this number, on this graph, is lack of rental housing. And so therefore, I would, I really thought that it was all about government regulation and red tape and stuff like this. Maybe you're right. It's about tax incentives or the lack thereof, CMHC and how difficult and how long it takes to get financing, this lack of accelerated depreciation, my argument about lack of leverage, which you didn't quite, agree with. But maybe what this says is we need to have a concerted effort on increasing rental housing.
Yeah, we absolutely do. And as I said, the secondary market, so the small mom and pop landlords picked up a lot of that slack in order to just bail us out. Otherwise, we'd be in an even worse situation than we are now. And it's an area where we do need to consider as well. And, I'll just introduce this and then we can come back to topic, is that with delays that we've had in the landlord-tenant board in particular over the last 5 or 6 years, it's gone to a point where small landlords are put at a disproportionate risk over even the large landlords. So for me, a 3% problem I can kind of spread across, and by the way, most of that problem is non-payment of rent according to the LTD statistics. It's about 70 to 75% of all applications filed. So for me, a 3% problem I can spread across my whole base. But if you're a small mom and pop landlord with 1 or 2 doors, that 3% problem is a 100% problem, and they're feeling very threatened. And so that pressure relief that we've had around rental housing is at significant risk. So we really do need to address a couple of things. One is, getting back to your point, is we need incentives to create rental housing, be them through the primary market with larger corporations, or incentives for smaller owners and smaller developers to create more rapidly some of that. And then the second piece we need to do is we do need to fix what's happening at the landlord-tenant board to fundamentally reduce the overall risk to those smaller landlords so that they can be part of the solution.
You've got another interesting chart here that is the same statistics, but for just the city of Toronto. I don't know whether this is Metro Toronto before the city of Toronto was amalgamated, or so I'm not sure exactly how your statistics are are derived, but let's assume it's the same geography, the Metro Toronto and the current city of Toronto, which makes logical sense. In the 1970s, you were between like 6,000 and 10,000 housing starts a year for about 20 years. And then for the last 20 years, it's like tripled to 15,000. And in fact, in 2015, you ended up going up to 30,000. So, you must have had a couple of really big condos, buildings open that year. And so this would suggest that Toronto is not necessarily the problem with housing starts. So if Ontario has a big problem with lack of housing starts and Toronto's not the problem, would that suggest that the problem is the 905?
Well, it could be the 905. Well, in this case, this would be CMHC data. So it would be their census metropolitan area. So I'm trying to remember exactly how expansive that was. It's more than just Toronto, the city. It would include certain cities adjacent to it. But I don't recall the exact definition. But in that piece of it, there is definitely a lot of growth. So if we go back to the original statistic that you were talking about from an Ontario perspective, right, you're correct in that we have the same volume of housing in general, but it's not keeping up with inflation, right? And you mentioned that. So that's a very, very key point because our inflation rate has increased significantly over that period of time. So really, we're falling behind. And even if we take a look at the GTA, that number is still lagging the overall growth of population of the city. Because what we typically see is when we have immigration, they tend to land at the major urban centers, Toronto, Vancouver, et cetera. And then some go to some of the secondary markets beyond that, but they're usually, a skip and a jump, right? So they'll land in Toronto, they'll stay there for a while, and then they'll move to one of the other things. So Toronto always bears the brunt of a lot of the immigration side of it. So as much as the graph looks like it's good, we got to remember that Toronto has grown significantly over the last 30, 40, and 50 years. So this data is really saying that it's not keeping up. And certainly when it comes to rental housing, right? Rental housing in Toronto, purpose-built rental housing has been really a mere shadow of what it needs to be and is more or less in line with the overall Ontario statistic.
So our immigration is increasing, our rural to urban migration is increasing, the gravitational pull of the major urban centers is increasing. Baby boomers are cashing out of their home equity and wanting to move into rental. Millennials can't afford to buy a house, so they're moving into rental. And lots of economists say that a reasonable amount of rental housing is critical if you want to have labor mobility and things like this, the ability for people to move to take jobs and things like that. And at the same time, as all of these trends have occurred, you've got flat single family home development and dramatic reductions in rental housing. And the only thing that's sort of improved is condos, which with, the statistic about Toronto having more cranes than any other city in North America, I guess makes sense. So condo development is maybe a little bit of the saving grace, but single family home development should probably be double or significantly greater than it currently is, given the increase in the population. And rental housing should be like 5 to 10 times greater than it is. So, sir, you're the expert. If you had to come to the conclusion that you wanted a dramatic increase in rental housing, purpose-built rental housing, and you were the Minister of Housing or the Premier of Ontario, what would you do?
There would be three key things that I would do. One is I would, at both the federal and provincial level, we would take a look at tax incentives that are geared towards accelerating the creation of new rental housing. So, and that can be in two buckets. One is at the corporate level and the other is at the small investor level. And I still believe the small investor level gives us the fastest rate of getting new housing out there, just because they're more nimble and the processes are easier for them. The second thing that we'd have to take a look at is we do need to consider the changes. So you're not wrong about municipal issues, okay? So On the municipal level, there is a fair bit of NIMBYism that goes on that does slow things down, and that translates into extended consultation processes. And I mentioned at the beginning that it can take 2 to 5 years to get a new development. Now, to be fair, the community should have an involvement, but at the moment, it's a lot of local municipal politicians are really just too afraid of upsetting the apple cart, so they just kind of wait for everybody to have their say before they kind of finally settle it all down. And people tend to respond better after they've had their say. But we've got to tighten that particular process. And then the third element is, while I don't agree with rent controls, and I think it's fundamentally harmful to tenants, there's not enough evidence that shows that blanket removal of rent control is going to be beneficial, especially when we have a supply issue right now. And when we've got a constrained supply, rent controls does afford some stability. But if we can get supply fixed, then we should start to take a look at rent control removal. But more on that particular side, what we absolutely have to do is we have to shorten the times associated with the landlord-tenant board review to bring it down to something normal. I don't know, Brian, if you know, but right now, hearings take in the order of a year to be scheduled. And if we go back to when it was functioning well, hearings would happen within a month. And that makes a significant difference as well.
Christian Szpilfogel talking about how we're going to solve our rental housing crisis in Ontario. Fascinating conversation. It's a really interesting article that you've written. I really appreciate it. We're going to take a final break and come back, and I'm going to change topics on Christian and see what he's got to say about some other interesting urban topic right after the message. Stay with us, everyone. Back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. This has been an interesting conversation with Christian Szpilfogel of Liferis, a real estate and startup technology company where he provides some consulting advice and some investment advice, etc. And he's involved in both the rental housing as well as the tech business in Ottawa. We've talked about rental housing and how critically important it is. He's taken us through some of the problems that have caused rental housing, tax issues, rent control issues, and that rental housing supply is dramatically reduced, and that it's something we've got to increase, and that's been fascinating. Christian, I wonder if I could raise a different topic for you just for a second. You're from Ottawa, you said. Ottawa amalgamated Ottawa, Canada, Gloucester, Orleans, etc., into one city. And I've heard some people say it was a mistake, and I've heard a lot of other people say that it allowed planning of transit and roads and a lot of other things to occur on a more metropolitan wide standpoint, and that you had less parochialism take place. There's an issue in Toronto right now about whether you want to separate everything out into pieces or whether you want to amalgamate. And there's some forces in Peel that want to separate out, and there's a mayor of Markham that says no, all of York should amalgamate. And he takes the example from Ottawa and says it worked. He takes a look at Hamilton, which merged with several neighboring towns in Hamilton, and some people are thinking that Kitchener, Waterloo, Cambridge should be combined, etc. And so my question to you is, has the Ottawa amalgamation worked?
Overall, I would say yes. Okay. Now, prior to amalgamation, some municipalities were incredibly efficient, but they were usually the younger municipalities, or Nepean, Canada, Stittsville, etc. They were smaller, nimble, and you could get a lot of stuff done very quickly. And the older Ottawa wasn't as nimble. When they amalgamated, what ended up happening is a harmonization of process, right? And bigger doesn't mean a more efficient process or a leaner process, although you do get some synergies and efficiencies out of it. But overall, things slowed down from a development approvals perspective in that capacity. So what we're seeing, in fact, is that a lot of developers are just going outside of the boundary and investing in towns and developing towns literally 2 kilometers beyond the boundary. So that really kind of tells you a little bit about how the process didn't really improve and has kind of slowed down. And then, of course, when there was amalgamation, if I recall correctly, because it has been a couple of decades now, but what ended up happening was that the salaries, et cetera, didn't necessarily stay the same across all pieces. They basically floated up to wherever the highest part are. So the cost of the actual bureaucracy went up as a result of it. So, but if I'm looking at it sort of dispassionately, if you will, I'd say that on the balance, it was probably better for us to amalgamate than to try and run, through a gambit of all kinds of different complexities between different municipalities that really needed to work together. And you may not remember this, but in Ottawa before amalgamation, there was this regional municipality of Ottawa-Carleton. So it was another level of government that tried to tie all these things together. So it also got optimized into the whole thing in getting that done. So at the end of the day, it makes for a more cohesive planning, a more consistent framework. So whether I develop in Canada or downtown Ottawa or out in the East End, the process is the same, right? Some of the participants might be different, but in terms of the speed and efficiency, like I said, we lost some of the nimbleness of the smaller ones. And my hope is that, if the GTA considers another consolidation like this, is that we learn from the smaller municipalities and figure out a way to make sure that we stay nimble.
Well, I have a bias on this question, which you probably gathered. In 1996, Ann Golden did a study called the GTA Task Force. And what she recommended is that Peel amalgamate, Halton amalgamate, York amalgamate, and Durham amalgamate, such that you would have 4 large cities, all about 1 million or more than 1 million people around the city of Toronto, and the 5 cities together would form not a Metro Toronto, but a sort of a GTA coordinating body. And her argument was that it did make sense to have 24 cities and 5 regions in what is in the next couple of years going to be the 3rd largest metropolitan region in all of North America, and that collaboration and cooperation and coordination are critically important. And just your comment about having one set of rules, one set of development fees, one set of zoning rules. Hopefully that bureaucracy doesn't add red tape. Hopefully it'll dramatically reduce the red tape. And that's sort of the idea of efficiency in mergers of companies and things like that. I really worried that we're going the wrong route, and we're going to end up having a balkanization of the Greater Toronto Area, just as we are on the precipice of a great future or a bad future with this dramatic growth. And so it's interesting. Ottawa-Gatineau, I think, should actually be one city, and you should go across the border. And that would be really radical. Anyway, thank you so much for joining us. I really appreciate it. I appreciate I understand that this is going to be a 6-part series, so I look forward to more of your articles. They're going to be coming out, and we can have more discussions. Our guest tonight has been Christian Szpilfogel of Alferius. No, I got it wrong again.
Aliferous. With
a consulting and capital raising and development company, both in the real estate as well as in the tech sector in Ottawa. Thank you very much, Christian. Really appreciate it.
My pleasure. It was a pleasure being here.
That's our show for tonight, everybody. I remind you, I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online at www.saga960am.ca, and all my podcasts and videocasts are available on my website after the fact on briancrombie.com. Good night, everybody. Thank you, Christian.